90-day breakouts. Now, for those of you who are new here, who don't know what 90-day breakouts are all about, let me get a little background. Now, I've done a lot of back testing over the years, and I found that there's a specific window for breakouts that tend to make the breakouts be less susceptible to false breakouts. If you look back in the 80s, late 70s, 80s, 90s, you'd find that a lot of traders were using 30-day breakouts. Then it moved to 60-day breakouts. And I found that the more traders use these breakouts, the less stable they become. But there's one period that actually has stayed fairly remarkable. That's remarkably stable. And that's the window right around the 80 to about 110 days. Now, I can't say that 80 is better than 90 or 90 that's better than 100 or 110 but they all kind of in the same ballpark. You kind of have the 25 to 35 day period, then you have the 55 to 65 day period. It's a window. And then about the 80 to about 110. So I just like to round that up to about 90. So 90 is not specifically the best period, but it's in that window, that 80 to about 110 window, that tends to give us the best period. And again, based on my back testing, when you move the breakout level to about the 80 to 110 day level, the breakouts tend to be more meaningful. In other words, they tend to be less prone to false breakout. And it kind of makes sense. You figure if a stock or any other asset is making a 90 or 100-day high, it's probably more relevant than a 30-day high, which could be random, especially with the volatilities that we've been seeing. I mean, look, NASDAQ is up over the year in about 45%. So think about the volatility, because remember, anything that goes up can move down too. Volatility works both ways. A lot of traders conveniently forget that, but volatility is a double-edged sword. So the point is, now you understand why I use 90-day breakouts. You could use 100-day breakouts. You could use 85-day breakouts. But generally, between 80 and 110 days tends to be the sweet spot. In my opinion, in my experience, in my back testing. This is what I found. Maybe you found something differently. But again, that's my experience. So what I want to do is I want to and lastly, before I forget, you may be thinking, well, the longer I go, the better the number will get. I did not find that. I found out that after about 110 days, the numbers get lower again. So it's kind of like there's a sweet spot where the number of false breakouts decreases up to about 100 days, and then it tends to go downhill. So it's kind of up and then down. So using a number like 150 or 200 days, like a one-year high, I didn't necessarily find it better. I actually found it worse. So again, the sweet spot's right between that 80 and 110 days, in my opinion, and based on my research and my personal backtesting. So I'm going to show you 10 stocks that are setting up for more upside based on the 90-day breakout. Now, some of these stocks, what's interesting is this, the majority of these stocks are companies that I was looking at and really bullish on right around February, March, April of last year, right when the COVID-19 was hitting us hard. These stocks, for the most part, tend to be very solid stay-at-home stocks. But with that said, there's a couple here that tend to be more related to going out, like Match.com, which we'll talk about. So again, I did not specifically make this list based on stay at home, going out. I didn't use that at all. I didn't use the COVID climate to pick these. I used the technicals to pick these, but after I picked these, I kind of looked at them and I said, hey, you know what? Most of these stocks are the stocks that were rallying in February, March, and April, and that may be a sign that we're seeing another wave, stay-at-home wave coming around. Remember, COVID-19 vaccine is not going to be around for the main public well into 2021. And that's after the first quarter, which is a flu season. So if we don't get relief and if unemployment rates go back up, we may be again seeing the same type of market cycle that we saw last March, April, and May, where a lot of traditional stocks sold off, but the stay-at-home stocks rallied. So this may be a sign that that's happening, because I'll tell you, these stocks sure have been rallying. And when I looked at them, I was like, these are the same stocks. So let's start this. The first stock, I'll just go in order. There's no specific preference to these. First stock on my list, Square. You guys know what Square is all about. It's a payment processor. More people working from home, More people shopping online, more people will use Square to process payments. But even if people go out, it doesn't mean that Square is going to have less market capitalization. People who are shopping in stores can use, in other words, traditional stores can use Square to process their payments too, although it's a little less likely. But again, the stock is up. It's a payment processor. I love the fact that volatility is not increasing. And I love the fact that the latest upside hasn't been like stretched out. So it doesn't look like this right here, like this period that occurred November 6th where it just jumped up. It's steady. The rise is steady and it's consolidating right now. Trading above the 50, 200-day moving average, very, very solid. And yes, it was one of my favorite stocks in March and April. The next stock, Chewy. This is a subscription service for pets. And yes, it was one of my favorite stocks in March and April, back when it was like at $50. These stocks have gone up. But again, I like it. The only thing about it is it looks like it may be a little too much too fast. So you may want to wait for it to consolidate for a day or two. But I do like this stock, and it is coming off of a nice little congestion right here. It may be setting itself up for another COVID cycle. So Chewy, another stock that I really like. This is Upwork. It's a, just to give you a profile so you could see what this company does. Recruitment, online recruitment service. 1 year return, 262%. And again, as you can see here, it's a Russell 2000 stock. A lot of these are Russell 2000 stocks. And the stock looks like it's getting ready for another leg up. And again, I love the fact that it's been congesting before going higher. So it looks like a breakout above a new high. I like to see periods that are horizontal, then vertical, horizontal, then vertical, horizontal, then vertical. So this stock is doing that well, and it looks like it's on a tear. Next one is Twilio. And boy, oh boy, this stock is on a tear. What do? They build cloud communication platforms. Remember what I told you, cloud is going to be big. 1 year return, 261%. And this stock is a leader in, they used to just be focused on texting, but now they're focused on all type of cloud services for computers. And again, look at this nice consolidation. The stock is breaking out after consolidating for a long time. Russell 2000 stock. And again, it was one of my top stocks about 9-10 months ago. It was a lot cheaper. And again, I'm not trying to rub it in that these stocks have all gained substantially. All I'm trying to say is there may be more upside if we go through that same period that we went last year. And again, folks, if no COVID vaccine comes our way next 2 months, and it's not looking like it's going to, guess what's going to happen? Peak of flu season, cold season, we're still not even there, and we're seeing the COVID death rates at new highs. Unemployment levels are high. Tomorrow we have retail report. May not get that Christmas rally. Stay-at-home stocks rallying. Keep an eye on this. Now, the next stock is Match.com. Now, I'm surprised that this stock is going up because this is not a stay-at-home stock. People date usually when COVID is not relevant, but the stock has bottomed out. I like how it's performing. I like that it's now, is this Match? I want to make sure. I want to see if this is the same company. If this is the dating site. Dating products. 39%. And I could have swore it was already a public company, but I guess not. I guess they just started trading recently. But again, I would be very, very cautious with this stock because it's a new issue, but I like how it's trending. And again, it's not seeing this strong momentum with gaps or trading action like this, which leads to reversals. It's very smooth and volatility is not increasing. One of the best signs that trading action is going to continue is that volatility is not increasing, and I like it. I like Match.com. Next one, Trade Desk. I mean, look at this thing. It's been going crazy. And again, Trade Desk was one of the stocks that we talked about. Technology platform, cloud services, cloud. See that? Anything with cloud is disruptive technology, stay-at-home technology, which is why it's kind of, I'm curious, all these stocks that I recommended in March of last year are going up. 1 year return, 278%. Look at the chart of this sucker. I mean, again, this is a great stock long term. And it's almost at 1,000 points. And again, notice it's moving sideways. Usually these stocks are horizontal, vertical, horizontal, vertical, horizontal, vertical. And right now it's moving horizontally, and I like the breakout. Next one, Autodesk. One of the best software companies. They're moving to a subscription model. I've recommended this stock back around March of last year. March, April of last year, the stock has been doing really, really well. Again, it's going through a sideways pattern right now. And I'm going to tell you something. For anybody who uses AutoCAD, who designs homes, engines, anything with design, engineering, you've got to use AutoCAD. There's very little other programs, and they've got you. It's like Adobe. If you're an artist, you use Adobe. If you're an engineer, you use AutoCAD. It's a subscription service. I told you about this company a year ago when price was probably close to about 180. Now it's about 280. You can look at my videos on YouTube from about 9 months ago, 10 months ago. But boy, oh boy, this stock is, and it's a great stay-at-home stock or not. Either way you go. But again, engineers need this company, and I like how it's consolidating right now. Next stock, Fiverr. Fiverr, remember, you pay $5, people do things for you. It's been a sleeping giant during the regular economy, but it woke up during the stay-at-home economy. The company's doing well. It's, again, reaching for new swing highs, trading above 50-day, 200-day line. The company does not really have strong competition. That makes it a very good stock, and it started rallying really well when the stay-at-home economy began. And boy, oh boy, folks, I'm telling you, next 3 months may not be pretty. Next stock, Trupanion. Dogs and cats. People love their pets. And what does this stock do? Let me show you. Let me give you the profile. Again, this is a company that I've been recommending and talking about for the last several months. This company is making new high. Direct-to-consumer monthly subscription service for medical insurance for animals. 204% return. Not bad, right? And again, the stock, it's a Russell 2000 stock. As I've mentioned, Russell 2000 is pent up. It's been pent up since Trump announced trade war almost 2 years ago. The Russell now is making headways. It's at new highs. And look at this stock. And again, people love their pets, and it's a subscription service, and it's only increasing, and the stay-at-home climate only increased demand for pets. Shelters around here in Jax do not have pets. My wife had to rescue a cat and send it to her cousin in up north. So again, this company is doing something right. And last but not least, Plug. Electric power, evergreen energy. The stock has been going crazy up. It's a Russell 2000 stock. This company is providing evergreen energy batteries for a lot of companies. As you guys know, Biden taking control of the White House is big for alternate energy. He wants to make several infrastructure changes that include alternate energy. The stock is up 835% this year, and it's one of my favorite companies. I think even Noah bought 3 shares of this stock. Anyhow, I like the stock. I like the fact that it's in the Russell. A lot of these companies are in the Russell 2000. So let me go through these again. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we got Square. We got Chewy. We got Upwork. We got Twilio. We got Match. We got Trade Desk. We got Autodesk. We got Fiverr, Trupanion, and Plug. I like the Trupanion and Chewy. They're both in the same category. I like Upwork, Twilio, Trade Desk, Autodesk. These are all cloud stocks. There's patterns here. But a lot of these stocks, I think every stock except Match, was a pick during the COVID-19. I don't know how Match got here. I guess now some companies are looking past the past the COVID-19, and some companies are looking again at the stay-at-home economy. But I'm going to tell you something interesting. Even if we go back past COVID-19, these stocks are all amazing companies. They were doing well before it, and if anything, COVID just gave them a nice push. But if the economy expands, so should each of these companies. And I hope that helps.